actually do this? Can you pay zero taxes with real estate? And the answer is a resounding yes, you can. But the bigger question is, but should you? So the strategy that actually being mentioned here is called the short-term rental loophole. And it's not that difficult. It's actually, a lot of people think that all real estate activity is passive, but there are several that are actually considered a trade or business, like flipping a property, being a contractor, being a developer, and short-term rentals, which means the average use of the house is 7 days or less. It actually puts it in that category where losses can actually be ordinary losses. It can actually offset your W-2 income and your other income. So I see these types of things and I immediately think it's great, but should I actually do it? Because what happens if, let's say you're making $200,000 a year and you manage to create $200,000 of loss from a short-term rental property? First off, that's a heck of a lot of property, because what you're doing is you're depreciating that property. What these folks are probably talking about is accelerating the depreciation by doing something called a cost segregation and moving what would normally be 39-year property, if it's short-term rental, into 5 and 15-year property. I know a bunch of you guys are saying it's 27 and a half years. That's residential when you are renting it out long. But if we're here, if we're a hotel, we're more than likely we're going to be in a different category. But the whole point is that we're taking that depreciation that would have been a longer period, and we're breaking the house down into its components, into its 5-year property, 7-year property, 15-year property. I'll give you an example. If you build a deck on the back of a house, that's a land improvement. That's 15-year property. You put in a driveway, you put in a walkway, you put in shrubs, you put in a fence. All those are examples of 15-year property. You buy appliances, that's 5-year property. The electric system that connects to it, the platform that it's on, including the foundation, the plumbing, all of that is 5-year property if it's attached to an asset that's 5-year. So you do an engineering report. We break these things down, and it's usually about 30% of the appreciated assets. It could be more, but it's generally right around that 30% mark. If you're doing manufactured housing, mobile homes, you're doing like if you have all the pads and you're just renting out the pads in an RV park or something, that is probably going to be closer to 80, 90% would be in that category of that 5, 7, 15 year, because those are land improvements. What you're then able to do is accelerate that depreciation. So we've already sped it up. It's no longer 27 or 39 years. It's now 5, 7, or 15 years. And then we use something called bonus depreciation under 168K. And depending on what year you acquired that property is going to dictate whether you get 100%, 80%, 60%, 40%, 20% depreciation of that under the Tax Cut and Jobs Act. It's been phasing out. We'll see if Congress changes that. So you would just check with your accountant, hey, this year or for this property, what would my bonus depreciation be? And they'll be able to tell you based off of when you acquired it or when you put it into service. It's actually when you put it into service, this is what the accelerated depreciation would be. Now you create this big, fat, artificial loss. And what this video doesn't show is that artificial loss does have a limitation. There's a net operating loss limitation or excess loss. I forget the precise term of art, but there's a loss limitation rule. And it's big. It's like 600,000 plus, but it's still there that we have to be aware of. So the question, I'm going to take it back to the original question I posed, is if I could get myself to zero, should I get myself to zero? And the answer for a lot of people when they're scaling up and they're building their portfolio is a resounding no, because you're not going to be able to get loans. You're not going to be able to get conventional loans, personal loans, things like that, because it's based off of your income and your credit score. You're out the door because all of a sudden you have no income. How do I know? Because I live this. I tried to get a mortgage. I was zeroing out. My partner and I, when we started up our firm, we're tax attorneys. We're like doing everything we can. Hey, look at this. We're so smart. Can't qualify for a mortgage on your house if you're trying to buy a house. Yeah, that kind of stinks. And if you're trying to scale up your real estate, that could really be harmful because you have no income. So plus, income isn't taxed all at 37% when you make $1 million. It's only the amount that is in that highest category. It's the more you make, the more they take of each piece, but you still have that, the 10, 12%, you still have the 22%. You have these categories of taxation that aren't brutal. Like, I'm okay paying 10% if I know I'm done. I'm okay paying 12% if I know I'm done. I don't want to pay 37% plus state tax, which if you're in California, could be like 50% of every dollar. I don't want that. So I'm all for lowering your income, but taking it to zero, that can be a little bit nutty. Now, going back to, I'm looking at an influencer on YouTube that's sharing this information. He's right. You can get it to zero. Now, I would say if you're that wealthy, you probably didn't get it to zero there, sir. Because there's a limitation of how much loss you can take. So if you're Mr. Millionaire making $1 million plus every year, no, you're not offsetting the whole thing unless you're doing things like real estate professional status, or you have other activities where you can offset the income, because maybe you're self-employed and you're able to offset it with other business loss. Otherwise, if you're W-2, you're still paying tax. But that's beside the point. He's referring to the short-term rental loophole. It works. You just want to make sure you're talking to somebody who knows what they're doing when you do it. In fact, you want to talk to somebody who knows what they're doing, just write strategy down below in the comments. Just type it in. We'll send you a link so you can talk to somebody who knows what they're doing, who can point you in the right direction and make sure that you know what the rules are, because he mentions a couple things, in writing. There was material participation, and there was a 7-day or less, and material participation, there's 7 tests. He referred to one, which is 100 hours and more than anybody else, and that's combining spouses together, so you could each do 50, and as long as nobody else did over 100, you're good. But there's lots of little tests out there to make sure that you're doing it right. And then that cost segregation and that bonus, you got to know what those numbers are so you can figure out whether, number one, there is a big loss, and number two, should you take that big loss all in one bite? Or number three, do I want to spread it out and show income, maybe a little bit of income, so I can qualify for those loans that I want, so I can continue to lever up? Write down strategy below and we'll do that. Like and subscribe. Share this to anybody you think will benefit.